Okay, everybody, welcome to the webinar. I'm Larry Berman, and I'll be your host for today as well as the presenter. I've got Dan Stanley with me here from BMO ETFs. He is the ETF specialist for Western Ontario, sort of from Toronto all the way to the next province. He's going to start off the presentation today with the top 10 innovations in ETFs. And then I'm going to talk about smart portfolios and ETFs and some of the things that concern me these days on how we're working the markets. So hopefully that works for everybody. I see you can type in questions at any time. After Dan's done, it'll take him about 20-25 minutes. We'll have about 5 minutes of Q&A there. Then I'm going to do a presentation. Hopefully it'll be something less than an hour, and we'll have about half an hour at the end of the call for more Q&A at that point. And I will turn it over right now to Dan to start.
Thanks very much, Larry. And let me say it is a pleasure to work with Larry and ETF Capital Management. One of the things I love is that we're just both focused, BMO and ETF Capital Management, on client education. And that's really what this presentation is about. So if we turn over to the next slide, the agenda for today, I'm just going to spend a couple of minutes telling you about BMO ETFs. Then we're going to get right into the heart of the presentation and talk about the top 10 innovations of ETFs. And we'll close off the presentation with a discussion of the tactical dividend fund, the funds that are managed by Larry himself. So turning over to the next slide, which is titled BMO ETFs Capabilities. The idea here that we want to get across is that BMO it is a Canadian institution, but we do a tremendous amount of work globally. So you can see that we launched ETFs in Canada in 2009. We have well over 70 ETFs. We are the fastest growing ETF provider in Canada, but you can see that we also have ETFs in Europe. 9 are launched over there, as well as 7 local ETFs that are trading in Hong Kong as well. So it allows us to bring that specialty, that specialization and expertise back here to Canada for clients such as yourselves. So looking at the next slide, we're looking at BMO ETFs relative to the ETF marketplace in Canada. We want to focus on 2 things here. The gray bar is the number of ETF assets under management in Canada. You can see that that number is growing very, very quickly. We are certainly, as we speak, north of 140 billion in assets under management. And you can see the dark blue bar is the portion that is BMO's sort of share of that market. As I said before, we are the fastest growing ETF provider in Canada, and we are rapidly, hopefully, going to become the largest ETF provider in Canada. We're number 2 behind iShares currently. Turning over to the next slide, one of the things that we do is spend a lot of time trying to empower investors. And I don't know if you've ever been to our website, do take a look at it. We've got some fantastic tools on our website, including our screening tools, our comparison tools. These are all tools that allow you to compare data, screen data on Canadian listed ETFs. It's really unique because there are a lot of tools out there that do this for mutual funds, but we were the first ones to really do this for Canadian listed exchange traded funds. Turning over to the next slide, our ETF dashboard. This is something that we initially designed for our investment advisor clients, our institutional clients. It's a fantastic resource that just gives you a sense of ETF flows in Canada. There's some trade ideas on there. Larry is on there periodically. It's just a sort of a higher level of service. If you are interested in receiving that, you can let us know via Larry, and we'd be happy to provide you access to that. So let's get into the heart of the presentation. As we said, the title of the presentation is Top 10 Innovations in ETFs. And one of the things I do like to highlight, even though we're going from 10 to 1, these are in no necessarily sort of order of importance, but there are a couple of ones that I will highlight that, in my personal opinion, I think are absolutely critical. And turning over to the next slide, you know, the equity ETFs, I think this is an obvious, really big innovation. You know, my definition of an ETF is an ETF is an open-ended fund that trades on an exchange and makes an index investable so that with one trade you can buy or sell a basket of securities without ever touching the underlying component parts. And the original ETFs that were created sort of in the early 90s, and you can see most of them were tracking indexes like the indexes that are listed on this slide, the S&P 500, the TSX, the Dow Jones Index. So these ETFs tended to be very large, well-diversified. They cost very inexpensive, between $5, $20 for every $10,000 that you invest. But I always say to people, don't let the simplicity and the low cost of these solutions fool you. These really are truly revolutionary. And the reason for that is because with one trade now, you could buy or sell a basket of securities. And this basket of securities, and this is crucial, was interchangeable for the stock itself. So if you knew that the stock and the basket were interchangeable for themselves, you know that arbitrage would keep the price of the underlying securities and the baskets, the ETFs, in line. And knowing that the prices of the two would be kept in line, as an investor, you can now use the ETFs as a replacement for those baskets of securities. And this helped you with diversification and reducing costs. So turning over to the next slide, slide number 9. In my mind, one of the greatest contributions of the ETF business is to the fixed income markets. And the reason for that is plain and simple. Bonds really weren't designed for individual investors like you and I. They're difficult to trade. They're difficult to create a diversified portfolio. Pricing isn't readily available for the average investor. As we say on the top of that slide there, bonds trade over the counter, which basically means that you have to have access to a large financial institution and their bond desk to get pricing and to buy and sell securities. Bond ETFs, and at the bottom of that screen, we've listed sort of 9 of our bond ETFs that if you put those all together, they make up the Canadian universe. But what bond ETFs are is really everything that individual bonds aren't. So they really level the playing field between investors like you and I and the big institutional investors like the Ontario Teachers Pension Plan, for example. So what are the benefits of bond ETFs? Well, they trade on the stock exchange. That's a huge advantage. The prices are visible because they trade on the stock exchange. And crucially, you can build portfolios with them. And the reason why we chose those 9 ETFs down there is you can see very clearly how specialized you can get in terms of positioning yourself along the fixed income or in the fixed income markets within your bond portfolio. And this is something that really was very difficult to do prior to bond ETFs existing. So turning over to the next slide, slide number 8, liquidity. I think it's important here to start with a quick definition, the definition of liquidity. And you know, in my mind, liquidity really is how quickly you can buy or sell assets for a stable price. And remember going back to the first slide where I talked about the importance of equity ETFs. I said that one of the big innovations of those ETFs is that they were interchangeable with the stocks themselves. And on this slide, that's represented by that symbol on the right where you have ZCN, which is our S&P TSX ETF, and the stocks to the right. Just to the left of that symbol, we've listed ZCN and its assets under management and its trading volume. And then below that, we've listed the top 10 holdings. Their average daily traded volumes are also listed there. The reason why we've done that is because not only does the interchangeability between stocks and ETFs ensure that the pricing of the two remain the same, but it also ensures that the liquidity of an ETF is drawn from both the trading volume of the ETF itself, in this case, the 4.7 million average daily volume on ZCN, but it's also drawn from the trading volume of the underlying securities. And you can clearly see at the bottom of that list where it says total index average dollar traded volume, $7.8 billion. That is a very, very large number and represents a tremendous amount of liquidity in the number that is accessible when you are buying and selling our ETF, ZCN, that owns those individual holdings. Going over to the next slide, this is sort of a continuation of that liquidity discussion because When you think about it, that added layer of liquidity can also dramatically reduce the cost of trading in an asset class, especially in the asset class of bonds that, as we just discussed previously, really are a very cumbersome and expensive asset class to trade. So what we find is this added level of liquidity allows ETFs to trade at tighter spreads. So and it's important to note that the liquidity of an ETF often shows up, or any asset, shows up in its bid and offer spread. And again, the definition here, the difference between, the definition, of the bid and offer spread is the difference between the highest price that a buyer is willing to pay for an asset and the lowest price that a seller is willing to accept to sell it. And the smaller that spread, more liquid the asset. So if I could draw your attention to the chart at the bottom of that page, and you look at the first ticker, the line there, ZS, the next column, it's maturity, that is a short federal bond ETF, the credit federal bonds. What is that column? Retail. That is the spread that if you and I were to go and buy a retail federal bond, we would face a spread of 1%. An institutional investor would face the next column. That's the institutional spread. It's significantly cheaper, 0.08%. But take a look at the ETF spread at 0.07%. So you can clearly see the benefit of the ETF, especially in the bond market, is you're going from, in effect, a cost of 1% to a cost of 0.07%. And that is especially extreme when you look down at things like long corporate bond ETFs as well. So again, the conclusion to be drawn here is that bond ETFs are doing an excellent job in leveling the playing field for investors all over the world. So turning to the next slide, slide number 7, titled Sector ETFs. And BMO offers a number of both Canadian, US, and global sector ETFs. And one of the things that are great about sector ETFs is it allows investors to target hard-to-access asset classes. It also allows you to take a particular position and try to generate alpha. Let's say you're bullish on real estate. You could buy or overweight ZRE, which, as you can see in the bottom left, is our equally weighted real estate investment trust ETF. Our sector ETFs also come in market cap weighted format. So the ZRE is equally weighted. You can see there the weight of each of the individual REITs that make up that ETF are in effect have an equal percentage allocation within that ETF. On the right-hand side, our global infrastructure ETF is market cap weighted. So the largest corporations get the largest percentage weight within that exchange traded fund. But again, ultimately the goal is the same. A sector ETF can be used to execute your view on a particular sector. Turning over to the next slide, currency hedging. And this is a slide that I think is absolutely critical, and Larry and I were just talking about this. You know, it's interesting. Most Canadian investors are infamously overweight Canadian investments, which means we really should be diversifying globally more regularly. But there is a huge challenge with that, and you take on additional risks when you invest globally. And the single greatest risk that you take on when you invest globally is currency risk. Because as soon as you start investing in foreign securities, your total return, which is given by the dark blue circle on the bottom right-hand side of this chart, is now the component of two parts. It's going to be the return of the local security, or the security in that local currency, plus the return of that local currency versus the Canadian dollar. And that could act as a tailwind, it will benefit you, or it could act as a headwind, it will hurt you. And trust me, currencies are an extremely difficult and very risky and time-sensitive thing to try to forecast. And that's why what we've done at BMO is when you look at a number of our foreign ETFs, whether it's our EFI, our US S&P 500 ETFs, we try to give you the option of currency hedged versions, which completely eliminate the currency risk, or currency unhedged versions, which means you are taking on currency risk. And you would usually buy an unhedged currency ETF if you had a particularly strong view that that foreign currency was going to increase in value versus the Canadian dollar. So turning over to the next slide, not only do we offer Canadian dollar hedged and unhedged options, one of the unique things that we've done is we've also offered US dollar options on our Canadian listed exchange traded funds, and that's crucial. It's important to note that they are still listed in Canada, they trade on the TSX, but they are US dollar denominated. If you're looking at our roadmap or online, you'll notice that they have a .u after them. So they're US dollar. What are the benefits to these? If you're wealthy, there's no US estate tax exposure there, there's no T1135 reporting. So there's a number of benefits to purchasing US dollar denominated securities, and we're very happy that we can provide those to our clients. So the next slide, covered call and option-based strategies. So when I was talking about the bond ETFs, we were talking about leveling the playing field between institutional investors and investors like you and I. This is another great example of that. You know, covered call writing is a strategy that is extremely valuable because you can enhance your income with a covered call strategy, and it also happens to be a very tax-efficient form of income. But again, these are strategies that as recently as 5, 6, 7 years ago were really only available and really only efficiently done by the biggest investors in the world. But by putting these strategies into ETFs like ZWB, our newly launched ZWC, or ZWE, which is covered call on Europe, we allow you to execute those strategies in one trade at a very low cost. Turning over to the next slide, this again is one of these slides that I do think is really important to get your head wrapped around. You know, we talked about those early ETFs, the first slide we talked about. Those early ETFs were all what are called market cap weighted exchange traded funds, meaning the largest companies with the largest market capitalizations had the biggest weights in the underlying ETFs. Now, these ETFs were also really sort of based on what's called the efficient market hypothesis. And in an efficient market, stocks and their market cap weighted indices, in theory, should reflect a company's value. But as we all know, humans are participating in the markets, and humans are emotional, so we have a tendency to drive stock prices higher than the inherent valuations of companies, and conversely lower than the inherent valuations of companies. And a market cap weighted index, or ETF, that tracks that index, that will inherit those emotional swings in the marketplace. And that's why what you saw was a move from the left-hand side of the chart, where we started with market cap weighted ETFs. We saw a move to equally weighted sector ETFs, and more recently, the move to what we call smart beta ETFs, which on this chart encompass what are called market factor-based and fundamentally weighted ETFs. So really what you're seeing is that companies started screening stocks according to sets of rules. So things like book value, cash flow, or sales. Those would be rules that are screened under fundamental weighted exchange traded funds. You also have screening for stocks that are momentum focused or quality focused or value focused. Those ones would fall under the factor-based smart beta category. But in effect, the goal of smart beta ETFs is really to either reduce risk, our low vol ETFs do that, to generate more yield. Our yield focused or our dividend focused ETFs are designed to do that as well. Looking over to the next slide, which is just a continuation of this smart beta discussion, these new smart beta ETFs, really what they're doing is they're taking the best of two worlds. You're taking the best of passive investing, which is low cost and transparency, and you're combining it with the best of active investing, which is a thought-through process, having a desired outcome. And you combine those two things together into our smart beta or rules-based exchange-traded funds. Now, number two, tax efficiency. It's obviously really critical. I don't want to spend too much time on this slide. There's a lot of information that's heavy on that. But just to say this, ETFs tend to be more tax efficient because fundamentally underlying an ETF, because they're not actively managed, there's less trading going on. And when we manage an ETF and when we trade for an ETF, like you and I, when we make trades, Revenue Canada comes after us for capital gains. We have a tax bill. So the less you trade, the lower the tax bill is going to be. And that's what makes ETFs fundamentally a very tax efficient structure in and of themselves. So turning over to slide number 1, and I would say this is arguably one of the greatest innovations and most recent innovations that we've seen. And it's the creation of the ETF-based mutual fund space. And as it says there, the growth in the ETF market has provided active managers like Larry with more opportunities when it comes to constructing portfolios, because now with all the ETFs out there, you can get more precise exposures. You can, things like smart beta, or as it says there on the slide, you can segment your fixed income solutions. You can now get access to hard to access asset classes, India. You've got cost-effective broad asset classes. So if Larry, for example, just wants exposure to Canada or the S&P 500, he can get it for 0.05%. And then you've got the efficiency of moving between asset classes. It's much more efficient to make 1, 2, or 3 ETF trades than if you were trading 30, 40, 50 stocks to change the particular investment portfolio. So I'm not going to go through the list, but that's the graphic at the bottom there demonstrates the value of these funds of ETFs, which is taking the best of both worlds of ETFs and actively managed mutual funds. BMO is a leader in the fund of ETF space. If you look at the total assets in Canada, roughly about $8 billion, actually probably a little more than that now. 2/3 of that is BMO. We have 7 of the top 10 mutual funds in this category. And I think it's an understatement to say that if we turn over to the next slide, that Larry Berman and the 3 funds that he is managing for us are one of the key reasons for our dominance in this space. So if you look at, Larry manages 3 funds for us, the BMO Tactical Dividend Fund, which has a focus on income, the BMO Tactical Balanced Fund, which is sort of a lower risk fund, and then the BMO Tactical Global Growth Fund, which is a global sort of go anywhere fund. The key point, and this graphic at the bottom here really demonstrates that, is that all 3 of these funds were really sort of designed to move with the market cycles. So when Larry is constructive on the markets, he's going to increase his sensitivity to the markets and generally lower the yield of the portfolio. When he's less constructive on the markets, he's going to reduce his sensitivity to the markets and try to generate more yield. One of the things we say about all 3 of these funds, they are excellent complements to pretty much any portfolio. The Tactical Dividend Fund itself is the fund that's been around the longest. It is a 5-star Morningstar fund. Another key point that I make about this is, if you look at that next slide, the strategy is a core and explore strategy, where he's taking tactical shifts around core investments. So he's using ETFs to do this. And one of the key things to remember is that there's no double dipping on the management fees. Each of the management fees of the underlying BMO ETFs, those are rebated to the cost of the fund. So again, you can see there the highlights of the Tactical Dividend Fund, for example. Larry's taking tactical shifts around core investments, which with the dividend fund tend to be dividend focused. He's getting his asset class exposure by using ETFs. And a key point that I want to drive home here, it's not just BMO ETFs. He has access to any ETFs from any provider out there. You can see the unique asset classes he's using, perhaps shares, covered call, fixed income. He can go to large cap, multi-cap, and of course, the world is his oyster, so to speak. He can go Canada, US, global as he sees fit. He is going to where the opportunities are. If you are interested in any of these funds, you can speak to your discount broker about getting access to the D-class version of this fund. So ladies and gentlemen, that's all I had to say. Thank you very much, and I'm going to hand it back to Larry.
Thanks, Dan. I'm going to be talking a little bit about the what I do in the we call them the sleep at night portfolios, and how we use some of these smarter ETF strategies. I'm going to share that with everybody in the next part of the presentation. Meantime, there's a couple questions that have come in for you, Dan, and we'll see if either Dan or I can answer these. So someone asked if there are plans for a covered call version of ZDH, and that would be the International Dividend Hedged strategy, and I would say that ZWE is probably the closest you're going to get to that.
Yeah, absolutely. ZWE is as close as you get. We're writing covered calls on sort of half the European market. And my other comment there is we are always looking at new ideas. So I would say a couple of times per year we sit down and we look for gaps in the portfolio. So for now, if you're looking for international covered call exposure, as Larry said, ZWE is a great way to do that. But rest assured, we are always looking to fill in gaps.
Question just came up if they are planning to offer DRIPs on BMO ETFs.
So DRIPs on BMO ETFs, it's my understanding that it
depends. So dividend reinvestment plan, just to be clear.
So I think if we're referring to, I believe that's set up through your own discount broker. So I have a DRIP set up on a number of the BMO ETFs that I own through BMO Investor Line. So if you have an account at Scotia McLeod, I believe you can, on certain ETFs, and it tends to be the ETFs that are dividend focused that pay out income on a regular basis. But it's my understanding that some discount brokers offer DRIPs on different ETFs. Did that?
Yeah, it's probably covered. A couple more here. How is currency hedge included in a foreign investment ETF?
So how do we actually do that? I mean, the nuts and bolts of that, and Larry can add to this, but we're using, in effect, forward contracts. So generally speaking, we're selling, let's say we want to create a hedge on the S&P 500. So we are going to sell 1 or 2 month US dollar forward contracts. So if the US dollar falls in value, that forward contract is going to rise in value to offset the decline in the currency so that we're hedged.
Okay, question here. Do dividends from a covered call ETF, for example, ZWB, increase as the bank's dividends increase? So there's two components to the covered call ETF. There's the underlying dividends from the holdings, and then there's the premium that comes off from writing the calls. Now, in the last couple of years, we've had a very interesting market environment. Those of you who follow markets closely, you'll know the VIX indicator, or the volatility index, has been running at multi-decade lows. And what that means is the premium coming off the options is actually decreasing. So what you might see, Dan, correct me if I'm wrong, in the bank ETFs, is that the banks are raising their dividend over the last year or two, but the premium is actually coming down a little bit because of that suppression in volatility.
Yeah. And the best example of that, if you want to look at the difference, ZWC versus ZWB, the difference in the premiums there are interesting because ZWC, we're writing calls on the broad Canadian market, which includes energy, and there's some more volatility there versus the banks where there's been less volatility.
One or two more here, and then we'll move on to my part of the presentation. Does BMO offer a robo-advisor?
We do have a robo-advisor. It is called Smartfolio. If you are interested in that, that's not my area of specialty, but if you're interested in that, I believe you have to speak with someone at BMO Investor Line. If you Google BMO Investor Line, they can help you with that.
And just for everybody's information, I'm working with a company called Wealthsimple to brand let's call it Berman version of a robo-advisor that will be active management, but in a robo style. That'll be out within about a month, so that's something to look forward to as well. There's a few other questions that are asking or explaining very specifics about, can you recommend for me? And we're not going to take any of those questions because we don't have a fiduciary obligation to know the client, and therefore it becomes very hard to say what is good for you specifically for your kids. There's one other question, ZST. Can you explain what ZST is, Dan?
So ZST is our short-term sort of a bond ETF. It's basically corporate bonds that are all in investment grade, but they all have a term to maturity of less than 1 year. So you get the yield from the fact that they are all corporate bonds, but you have that low duration because they all mature basically in less than 1 year.
Okay, let me now see if I can flip the presentation over. Hopefully everything rolls over here. Yeah, looks like we're here. Okay, so thanks very much, Dan, and again, a very special thanks to BMO Global Asset Management and BMO ETFs for being a great partner, educational partner with us for going on 7 years now. So we're very excited, and thanks once again to BMO ETFs. There's a couple other questions that have come in, and I'll try to answer those in the Q&A part of my presentation. Let me get right into it. Warren Buffett, I'm a value investor at my core, and you know, Warren Buffett is the classic example. If you opened a dictionary and said, what's a value investor, and there was a picture there, you would probably see Warren Buffett. So I'm very much a Warren Buffett type of investor, where I'm always looking for good relative value and always looking at the risk of an investment. Often people say, Larry, you should change your name from Berman to Berman because you're always so negative. And I'm not always so negative. I just look at the risk side of an investment first before I look at how much I can potentially make from being in that investment. And what you'll notice if you pay close attention to BermansCall is that when someone asks me a very specific question and saying, you know, should I buy this for my portfolio today? I don't know who that person is. I don't know if they already own it. I don't know if it's 50% of their portfolio already. So I'd be doing them a disservice by saying, sure, go back up the truck and buy more, because I don't know enough about them. But what I do say is, well, you know, this ETF or this stock at $30, I would put a half a position on because it could easily fall to 25, where I would actually want to buy more, because when I look out a couple years, I think it could be worth 35 or 40. But short-term risk may be negative, and that's kind of how I think about things. So I'm going to pick on Warren Buffett a little bit through the presentation today. I'm going to talk about debt and growth, and that's one thing that really concerns me about the world and causes me to be very, very cautious now into the 8th year of our economic expansion here. Then I'll go into talk about some of these smarter ETF strategies, how I use many of them in the portfolios that I run for clients, and I'll give you some ideas on what you guys can do for your own, and ultimately look at the solution. And, you know, ETFs are generally thought of as passive investments. You buy the index, you get the index. And so for stock selection portfolio managers, many of them who come on BNN, CNBC, and the like, they'll tell you, no, because if you buy an index, you're buying a lot of bad companies. And I know what the good companies are. I know, so you should invest with me because I can do that. Well, I'll give you an example of our friend Warren Buffett here, because, you know, Warren was until recently the biggest holder of IBM. 5 or 6 years ago, really bought into the fact that they were going to turn themselves around and they were going to be a great company, et cetera, and most recently he admitted that they weren't able to execute. And so even the best of the best, like Warren, don't know what securities are going to outperform at any point in time. What I love about ETFs and why we use them the way we do for asset allocation is because the research is overwhelming that people trying to pick specific securities to try to beat the market, vast majority of them don't beat the market after costs and fees, even including all the professionals. If you run a concentrated portfolio of 5 to 10 stocks, absolutely you can shoot the lights out and get a fantastic return. but guaranteed you're going to have significantly more volatility. And when the markets are going up, nobody cares too much about volatility. When the markets are going down, it's everybody's problem. And don't let a bull market confuse you with brains when it comes to investing. So I want to talk a little bit about GDP and growth in general. So that requires a little bit of an economic policy refresher, and that is looking at the concept of GDP and what drives central banks and governments to stimulate the economy. GDP stands for gross domestic product, or it's the output of the economies as we know it. Prior to World War II, the concept of GDP really didn't exist. Formula for GDP is consumption, that's the C, investment, so things like building an apartment building, a road, a bridge, a library, a hospital, you name it, infrastructure. Then G is government, the cost of running the government, what we domestically produce and export minus what we import, because that job is created somewhere else, and that's a detraction from what could be good for our economy. This X minus M is what Donald Trump is all about these days, and wants to bring those exported jobs that went years ago, bring them back to the U.S., cut imports, trade wars, etc. So every policy we have today, no matter what government it is or what central bank, is designed to stimulate GDP. Milton Friedman on the bottom and John Keynes at the top are the fathers of monetary and fiscal policy. And so to stimulate GDP, when the consumer pulls back, what Keynes told us is that the government should spend money. Okay, so borrow money, boost spending. They should invest in infrastructure, and that would offset the C that's declined because of the recession, and overall GDP will be stable. That made a lot of sense, 1930s, 1940s, 1950s, and so forth. Today, with the amount of debt in the world and the excesses that governments and corporations and in Canada, individuals have leveraged up is staggering. So now we're in the midst of, globally, of central banks saying, hey, it's time for interest rates to start going up. And what you're seeing in part today and earlier this week in the marketplace is some investors getting very, very nervous that the liquidity train ride we've been on for years now, funded by central banks, is possibly coming to an end. What I think will ultimately happen is if we get a couple more rate hikes and the stock markets pull back 15 or 20% or more, that they'll start cutting rates again because they don't want to dip into a recession. And so you have this underlying policy directive, first started by Greenspan actually in the early 2000s to combat the tech bubble bursting when he first put interest rates to zero. But even before that, in 1998, where a hedge fund called Long-Term Capital blew up about $4 trillion worth of bonds in the high yield market, he called all his central bank buddies at that point and said, hey, we've got a liquidity problem in the financial sector, and all the central banks cut rates at the same time. That event became known as the Greenspan put, and what's known as the central banks will always have your back. But when they put interest rates to zero, what it does is for the aging demographic and the aging population that every day gets a little bit older, that 60-year-old person that's contemplating retirement and needs their money to last 30 or 35 years and can't get a safe return without a lot of volatility in retirement, they're being forced to go into high dividend paying equities. And the volatility in equities, of course, is very, very different than the volatility in fixed income. So we have this challenge, and I'll talk about it a little bit more. The best economic period we've had historically, ladies and gentlemen, was in the post-World War II period. They called it the Golden Age. And, you know, there's talk that Trump's policies are going to take us back to 3% plus 4% GDP, and frankly, I call bullshit. Because during those periods, historical periods, we had every woman was having 3.5 or 4 kids in North America, and in Europe we had a very, very young population. The average age of the population back then was in the early 20s. In the early 20s, you're still having your kids, you're still buying your homes and expanding. Now the average age of the population in North America is about 40. In a company like Japan, that's the oldest society in the world, the average age is pushing now the 50 mark. The number of people in retirement today around the world over 65 is probably around 10%. That number is going to triple within the next couple of decades, because today the average woman is having half the number of kids or less than they were back then. In 1952, when the old age security model was spread out that everyone who was retired that didn't have the means would have access to this additional benefit from the government, which we don't pay into, by the way, which is funded by current taxpayer dollars. Life expectancy was 71. So it made sense at 65 for the government to cover the people who have not saved enough for retirement, to give them a little bit of a top-up. But what it is today, with life expectancy in the mid-80s, and 20, 30 years from now they expect it to be probably closer to 90, the math simply doesn't work anymore. So a lot of these policies that were put in place back then kind of made sense. In 1952, 12% of households had an automobile. There were very few interstate highways in the U.S. The Highway 400 series in Canada, the Tecan Highway, didn't exist. They were mostly dirt roads, well, some paved roads. But as the adoption of vehicles increased, the infrastructure was built out. Now all those roads are full of potholes. Every time they built a new road, a Howard Johnson's popped up on the corner, and then a gas station, and then a motel, and so forth. Today, all those roads are full of potholes, and when we spend the money to fix those roads, we don't get the same economic leverage and multiplier kick that we got back in the 1950s and 60s when we were first building those things out. In the 1973 to 1998 period, that 25-year window was the best period in the last 100 years for capital market returns from equities and fixed income. You remember in the late 70s, early 80s, where interest rates were in the double digits, ever since have been falling. We caught the tailwind from falling interest rates and coming off the high inflation of the 70s, and that was wonderful for equities and bonds. But we hit this problem with the Great Recession in 2008 and 9, and that's the dashed red line on the chart that you could see in the graphic on the right. And from that point on, central banks of the world, as a percentage of their economy, started to borrow and spend. It's to stimulate C plus I plus G and get GDP going. And since that point, if you look at the average growth in the world, it's that dashed black line at the top. That graphic has come down from what we were growing at 3% plus globally before that to now something closer to 2%. And that number is only going to keep going down and down and down for many reasons I'll cover. But the amount of debt in the world today, if interest rates were to normalize and go up, the governments would have to shell out. Like in the U.S., for example, right now, the Fed, the Treasury pays out something like $250 billion a year in interest costs. If interest rates were to normalize, that number would go up to $800 billion. So that's the problem, and one of the reasons why I say interest rates are going to stay low for a very, very long time and can't normalize. And we're going to be in this sluggish growth world because of the debt and the demographic outlook. And I challenge everyone I make that statement to come back to me and tell me it's going to be different. This is a graphic I actually showed on BermansCall this week in the educational part of the show. These are G7 economies showing their labor productivity. So another way of thinking about what potential GDP is how much productivity we get out of that worker and the potential size of the growth of the labor force, i.e. birth rates, i.e. immigration. And so the far outer markers that are more to the north of the screen and to the right of the screen, say Japan, going back at the average of the last 50 years, they had labor productivity of 4.5%, and they had a labor force growth of 1%. The sum of those two had GDP averaging 5.5%. Look at where Japan is on average in the last 5 years, because the population is actually shrinking in Japan, and the productivity, again, the gains from the implementation of computerization and robotics and all these things, the marginal gains in terms of productivity are few and far between. And it's the same story for all the G7, all the biggest economies in the world. We could add China to this too, and it's the same story. China is one of the older economies in the world, and their demographics are absolutely terrible. 51.5% males, 48.5% females because of their one-child policy. Approximately 3% of the male population needs to leave China to find a spouse in the traditional way of thinking of things. The World Bank expects the Chinese population, like Japan, to peak within the next decade and population to start to shrink. You can counter that with an India, where the average age of the population in India is about 23. And India today is where the developed worlds were 50 or 60 years ago in terms of what's coming for them in terms of growth, productivity, and demographic push and tailwinds. So I'm really excited about other places in the world. The world today is actually, population is 7.4 billion. It's expected to be in the next 50 years, 9.5 billion. And the vast majority of that population growth is not coming from the developed world. It's coming from the emerging world. In particular, sub-Saharan Africa, places like Nigeria and Kenya. Nigeria today has 400 million people. Nigeria is expected within 50 years to double in size to 800 million people. And today, Nigeria's biggest problem is warfare and clean water. So the growth is going to come, but it's going to be not in the developed world. In Canada, this chart shows the life expectancy and the red line at the top. And you can go back and look at 1960, where that life expectancy was about 70 or 71. Drawing that forward to today, we're looking at about 80 to 81, and projecting that out in the future, we're looking certainly at a push towards 85 to 90. The blue line at the bottom is the population age 65 and over. Back in 1960, about 6%, 7% of the population. Where we are today, it's about 17%. Projected into the future, that line is going to rise well through the next century, given the demographics and birth rates. So when we factor that green line, and what the green line is the percentage of people working, paying into the tax system in their full capacity in their employment, compared to the people who are not working, either the youth under the working age, or the people who are retired and no longer actively seeking employment. That ratio is going to get worse and worse and worse dramatically for the next 20, 30, 40 years. That means fiscally, governments cannot keep spending. In the U.S., for example, the current bill is talking about Medicare and Medicaid. They must cut trillions and trillions of dollars out of those social benefits in order for there not to be a catastrophe in the amount of debt owed. Yet the liberal side of the argument, the Democratic side of the argument, says, well, we earn those benefits, we can't take them away. Even many people in the Republican Party or Conservative Party in Canada feel the same way. The problem is the math no longer works. We must make these changes, because the amount of people paying in are not going to be there in the future. And it's a gross problem that we have for growth and for debt management. And again, it's these demographics and the fact that debt levels are already intoxicating that I just don't see huge growth. Having said that, a 1 to 2% world growth rate over the next 50 years is not bad. We just need to know how to deal with that, and we have to recognize that we shouldn't be paying a growth multiple for the marketplace when we're in a low growth world that is not being fueled by liquidity and leverage. And that's really been the story since the Lehman moment. And when that comes to an end, we're going to see some market volatility. This was a forecast for the potential growth in Canada, looking at GDP and labor growth, etc. And one of the recommendations coming off of Bill Morneau, Finance Minister Bill Morneau's Growth Advisory Council was that we must increase immigration and that we must raise the retirement age. Trudeau's policy of rolling OAS back from 67 to 65 that the Harper government started to graduate is actually stupid. It's dumb, the math doesn't work, the retirement age and these benefits need to get pushed out because we're all working long. We're going to be working longer to fund our retirement needs. So, you know, we've got a growth problem in the world, and I talk about a coming pension crisis, and there'll be one. Pretty much every pension fund in the world is grossly underfunded. Now, when we look at risk and return, it's really important to consider the risk side, and almost nobody does that. Now, risk is measured by standard deviation and the volatility of returns in your portfolio. When we look forward 10 years, according to research affiliates, the red dots are equities. U.S. large caps, given valuations today, and small caps, given valuations, may have a real return, so net of inflation, of less than 1% a year on average for the next decade. Where international markets that are not as overvalued today, like EFI, so EFI stands for Europe, Australasia, and the Far East, and that is the developed world outside North America, and in emerging markets where valuations are reasonable these days compared to the U.S., where we still could see potentially good returns, but with a standard deviation in emerging markets of around 25%. And what that basically means in English is that during the next recession or big bear market, emerging markets probably fall 2 standard deviations, typically in a bear market, or around 50% in this case. International markets look for a fall of around 35%, maybe 38% in that range. U.S. small caps, 35 to 40%. U.S. large caps might be 25 to 30 because the expected volatility is somewhat lower. When we look at the fixed income, the blue dots, the expected returns there are very anemic. So where do you go today to get a safe return in your portfolio? The answer is it's difficult. Every pension fund in the world has obligations for the people that worked for them for years ago and have already retired, and the people that are currently working for them. And over the last 20 years, they've averaged 7.2 in terms of returns. They need, in order to fund your retirement to the age of 85 or 90, needs a return of 7.5%. If returns over the last couple years continue to be pretty anemic for pension funds on average, they are going to be insolvent and run out of money, or they're going to need to be topped up by governments or corporations that have those obligations. So these are very real concerns, and something that's troubling to me. Looking at one more way of looking at this, back in 1995, you could build a safe retirement portfolio, all out of a high-quality corporate bonds, get a 7.5% return with very low standard deviation. So in a bear market for bonds, a real bad bear market like 1994 when the Fed aggressively started raising interest rates, 12% decline in your portfolio. Pretty much everyone can handle that. They wouldn't be happy with it, but they could handle it. Today, in order to get even strive for that 7.5, and I'll argue that it's not likely a number, certainly until we get a correction. You're looking at a 34.5% risk measured by standard deviation in the next bear market that we're likely to see. So those are some of the things that are troubling. I guess the good news is there's things we can do about it. You don't need to go into cash that doesn't pay much or stick your head in the sand. I basically show this graphic on all the presentations I do. And when I'm building portfolios, when I'm using ETFs, I use this concept of the Sharpe ratio on a forward-looking basis, and I want to overweight or invest more in the areas that have the highest expected return with the lowest amount of risk. And I'll show you kind of how I go about doing that. And then I compare everything to the risk-free rate. Risk-free rate being a money market fund or a GIC that today, if you've got a good one, you're getting paid 1.25% in Canada. That will rise if the Bank of Canada starts raising interest rates. But for now, 1.25% is kind of the best case scenario. They probably have some GICs out there with teaser rates and such. So in order to build a portfolio that's going to strive for the highest return possible with the least amount of risk, you need to understand the concept that if you're going to add something to your portfolio, don't just call into BermansCall and ask the question, should I buy this? Do the analysis in your mind and say, well, what is the volatility of this? And you can calculate that. You could put the price, and you can download this from many, many websites, the prices daily or weekly or monthly of the various securities. You could calculate the standard deviation of that return and get an idea of what the risk is involved in owning that asset. And now you can say, well, what is the upside to potential? And you could do something as simple as saying, well, where's the next area of resistance on the chart? How much is that above where we are today compared to the volatility that I have to assume to get that expected return? And you can calculate this Sharpe ratio. And what you want to do is with all the things you want to own, for me it's ETFs, calculate that Sharpe ratio, and you simply want to have more in your portfolio of what has that better risk-adjusted return. So one of the areas of smart indexing that Dan kind of touched on is these different ways of factoring an index. What I call the dumb index is the index weighted by the capitalization of the company. Basically meaning that, you know, the bigger the company, the more weight it has an index. And that's fine, except when you get into the FANG market like it is today, where there's a handful of stocks and they represent a quarter of the NASDAQ, and whatever they do really defines the broader market. The breadth of the market, meaning the number of stocks participating in the rally over the last couple months has been in sharp decay and decline. The indexes can still go up if those handful of stocks that are the biggest ones drive the market. I would much rather own increasingly on a go-forward basis, not based on market capitalization necessarily, but based on buying the best quality companies, buying companies with a lower amount of risk with the same type of potential return, or stocks that have outperformance characteristics and have strong momentum behind them, and companies that are smaller in size compared to a similar larger company that has much more growth down the road, or like Warren Buffett, companies with good financial ratios. But mentally, individuals have difficult processing this. And this is where the computerization of the financial markets, I think, is quite brilliant, and with artificial intelligence. The firm BlackRock, the people who manage the iShares universe, about 2 months ago in their quarterly earnings announcement, mentioned that they laid off about 20 or 30 portfolio managers and replace them with artificial intelligence selection of their securities. And I think the world is going in that direction. One of the great things about it is a computer, you know, you don't need to pay it sick leave and things like that. The bad side about it is it does cost jobs. The good side about it, there's lots of pros and cons, of course, is that ultimately it drives down costs. And so these ETF smarter indexes will continue to put price pressures on the marketplace as well as it gets even more computerized. So that's a pretty good thing. So what I want to show you is this study that was put out at a conference, a Smart Beta ETF conference, and it looks at many of these factors like momentum, like quality, like low volatility, min vol, size, and value. And it did a study for 15 years from 2001 to 2015. The bottom line there is the return of the DUM index, the market cap weighted index, where the squares on top, if they're above the black line, they outperform the index, and if they're below the black line, they underperform the index. Now, there's no pattern where one year you buy this, the other year you sell this. There's no pattern like that. Believe me, folks, I've looked for it, and there isn't one there. But there are some ideas that come out of this. What we do notice when we look in aggregate of these smarter indexes is that no matter what the strategy is, they all do better than the DUM index in the long run. So value over that 15-year window beat the DUM index by 3.3% a year. Small caps for the size factor beat by over 3, momentum 2, low volatility 1.75, and quality 0.71. All these factors are really what active portfolio managers are doing. So when that guy comes on BNN and says, I know because I know, they're looking at a computer model. They're screening for good qualities of companies. Some of them may actually go talk to the management and interview, and that's a whole other thing. But the vast majority of them are looking at computers to drive those decisions anyways. So the manager can really be removed, which takes a huge cost out of the cost of active management funds. These smart index ETFs on average, you're looking at 35, 45, 55 basis points. And what you have to do is compare that to the full cost mutual funds with advisors that are charging in a global fund these days somewhere around 2.5% in Canada. So bear that in mind when you say, well, it's not 5 or 10 basis points like the S&P 500. Yes, it costs a little bit more, but in the long run, you're getting tremendously more value in these smarter ways of creating indexes. That's a big message here. Another big message is when we look at what's called diversification, and that is combining different styles of investing, value, growth, momentum, etc. And when this is another study that was done at this ETF conference I was at last year in New York. And when you look at, for example, the cross-correlation, so what the correlation means is that a correlation of 1 means it's identical. The two assets go up and down 10%, down 10%, up 5%, down 5%. They're identical. There's no benefit of diversification. So if you were to look at company XYZ Canadian Equity Fund and company CDF Canadian Equity Fund and looked at their correlations, the vast majority of funds in Canada will be correlated at around 90%. So if you're buying the ABC fund and the XYZ fund and the HKY fund, you're not getting any benefit of diversification. Where you get the benefit of diversification is the different style of investing. So momentum compared to value, for example, actually has a negative correlation. Small caps compared to momentum have a small negative correlation. Illiquidity compared to momentum has almost a zero correlation. And what a zero correlation means is the prices and the returns of those different strategies are completely independent of each other. And the more things you can put into a portfolio that have low or slightly negative correlations, the better you can diversify. And that's a huge message. When you look individually at these factors and look at their standard deviations over that 15-year window, the volatility of the average factor was 12%, measured by standard deviation. And the excess return for the average across that window, 2.4%. If we took all the factors together and equally weighted them and put them all in the portfolio with the same weights and not cared about which one is which country and which, just use all the different styles of investing, and then looked at the returns of the equal weight portfolio, the volatility went down considerably because of the benefits of diversifying the investment style across these smarter indexes. And you still had the same average return. So you're able to use these smarter ETFs to lower your risk factors. And that's a really important message here. Looking at the biggest bear market in history during the 1929 to 32 decline. So this study done by a firm called AQR, which did the other studies, went back to 1926. And they looked at the Sharpe ratio. Remember I talked about that return adjusted for risk, net of the risk-free rate. They calculated these for the various different styles. And then what they did was when you combine them all, how good was it? And then they looked at the drawdowns. So during the Great Depression, the DUM index, the market cap weighted index, fell 82.5% from peak to trough. The small cap or size factor fell 34%. The value factor fell 43%. The momentum factor fell 75%. But if you used them all and equally weighted them, you fell 24.2%. That is a game changer, folks, in terms of being able to sit through the worst period in history. So I'm going to run you through some of these smart strategies and basically how to think about them and how to use them. Now, what we don't know ahead of time is which one is going to perform the best. So in the momentum strategy, these are three of the bigger ones that are being used in the U.S. There's a couple momentum strategies that have First Asset, for example, has some momentum strategy ETFs here in Canada for the Canadian market, for the U.S. market. These are three that are listed in the U.S. Two of them are global, and one is the U.S. one. My point being is you don't need to know which one. You want to diversify across all of them. And what tends to happen is you get a higher average return than two of them and lower risk than two of them. So you start to get that move in the return and risk quadrant towards the upper left side of that risk return quadrant. And that's where you want to be, generating the highest return you can get with the lowest amount of risk. So there's the momentum factor. We look at the value factor. In this case, we're looking at the S&P 500 Guggenheim pure value. And if we were to look historically over the last couple of years, value obviously did worse than the rest of the market. Financials, for example, are deeply in the value area. There's no technology in value typically. So it hasn't done that great. It has an average return of around 5%, as you can see there, with risk of around 17% standard deviation. Then there's an international value one, which is the MSCI version, and then the Cambria Global Value. Again, combine them all, get a better average return and less risk in this case than all three of them combined. Looking at the low volatility or low beta factor, BMO has three of them. You've got the ZLU, which is the US version, the ZLI, which is the international, and the ZLB, which is the TSX version of that. Equally weight them all, you get lower risk than all three on average and a higher return than two of them. Now, you might ask the question, well, shouldn't I just buy the U.S. one? Well, there's no guarantee that that U.S. one is going to continue to outperform in the future. Those are past returns, and in every financial document ever created in our industry, past returns are not guaranteed. And looking at past returns to judge what may or may not come in the future is a bad thing to do. You don't want to do that. You need to have a sense of what ZLU is going to be in the future, what ZLI is going to be in the future, and what ZLB is. And I'm going to show you in a little bit how I go about doing that. Then there's the dividend factor. Most of you probably very overweight dividend stocks. I show 3 examples here: the iShare version, the Spider version, which is State Street, and the Vanguard version. Those are the 3 largest in the U.S. Looking at equal weighting them, again, reducing the risk. In the case of the Spider and the Vanguard version, their style of selecting dividend payers are very similar. So those 2 ETFs are going to have very similar returns. The iShare version has a very different methodology. It is important to understand what they do in terms of selecting their securities and how they weight their sectors versus capitalization, etc. But again, even without knowing that, you can lower your risk in each one of them by equal weighting them. In the quality spectrum, BMO's got 3, a European, a global, and a U.S. quality factor. And again, same idea, less risk than all 3. In this case, the international exposure, the global, and the U.S. have done a little bit better. But generally speaking, you still get that higher average return and lower risk. Putting all the factors together, so everything that we've talked about and looked at, and equally weight them all. So you've got your group of quality ETFs, your dividend ETFs, your value ETFs, your momentum, and your low volatility. You can see now over time, and the longer our time frame, the more you're going to get the benefit of that lower average risk and higher average return as that diversification benefit works for you. We can look at the covered call, adding covered call, because while they're not specifically smart indexing, their path of returns are slightly different than other things. And so incorporating covered call strategies into your portfolio at times makes a lot of sense. So this is the comparison of the equal weight bank, ZEB, to the covered call banks. And I get the question all the time on BermansCall. You know, which one should I own? Should I buy them now? And for about 2 years, starting in late 2014, where the price ratio, or total return ratio of ZEB relative to ZWB got to the upper bounds of our trend channel. And usually when that happens, you get a better total return with your ZWB than with your ZEB. You want the enhancement, so when the market peaks overall and goes sideways, you'll do better in ZWB than you will in ZEB. When the market starts to trend upwards from a low point, like we saw in early 2016, where things were selling off aggressively, that's when you want to get out of your covered call strategy and go back into the ZEB, which is what we did in our portfolios. And now we're looking to have more ZWB than ZEB, because I think we're in for a period, maybe a year or two, like we saw in 2014, 2015, 2016, where the covered call overlay is going to give you a little bit more enhancement to your total return. So there's some ideas there on how to use those. Now, I've talked a lot about not liking the markets. So in my sleep at night portfolio, my exposure to the U.S. market, in addition to some other ETFs, is primarily a high dividend covered call strategy with ZWH. That ZWH has exposure to the U.S. dollar, and as well as the put right strategy, ZPW. When I combine the 2 of those together, I reduce my risk compared to owning either one of them, and I have a good average return between the 2 of them. When I compare those 2 to ZSP, which is an unhedged version of the S&P 500, the return over the last few years has been better in the broad market, but you're doing so with 40%, 50% more risk measured by standard deviation in your portfolio. So when the markets ultimately do correct, ZSP is going to go down in all likelihood a lot more than a combination of ZPW and ZWH. But the additional benefit, ZSP yields about 2%. The combination of ZPW and ZWH is going to yield me somewhere around 5.5% right now. So you're getting about 2.5 times the yield and about 1/3 to 40% less risk, and you could still be in the market. If the markets keep going up, you're going to get about 30 to 40% of the upside, and you're going to get 2.5 times the yield. So I hold this right now. Whenever the next 20% big correction comes, whenever that is, I get rid of my ZWH and ZPW, and I buy back my ZSP or my ZUE and get my maximum upside when the markets start to recover. And then finally, the use of options. And I've launched some products for my clients, some tools to do option strategies. Those of you who are in registered accounts will have a little more difficult time with this because of the rules around registered accounts and optionality. But those of you in cash accounts can certainly, or margin accounts specifically, can take advantage of something like this. So I did this snapshot in January for the roadshow that we were doing live, but it still really applies. So the value of the SPY ETF, and that's the graphic at the top there. What I did was I went back to the start of that ETF in 1993, and the red line is the maximum drawdown during the year, and the green lines are the maximum rally during the year, and the dotted lines across in blue and in brown there are the trend lines. So basically, plus or minus about 10% are the points where it makes sense to start being a seller on the high end or a buyer on the low end, looking back over the last 25 years or so. If you look at the average total return, price total return over that window was a little under 8%. Total return including dividends in the ETF was almost 10%. So there's some magic in that 8 to 10% number. If you look at the standard deviation during that period, it was about 14.5% as measured by that ETF. So a couple of things we could do. If we don't like the market today, standard deviation in a given month is about 4%. So we could wait every month. We could write an option for the next month. And so in the middle of January, writing that 1-month option for February, you took in a premium of 73 cents if you hit the bid to sell the option. If you did that every month for a year until you get full, your running yield is 3.86%. Now, if you didn't want to do that every month and say, well, I'm happy buying it 10 to 14% lower, 14 being that one standard deviation. If you wrote a 1-year option to buy the market 14% lower, you would have taken in a premium of $5.63. That's an annualized return of 2.48%, which is a higher yield than the S&P 500. And the first 14% is riskless because you don't own it until it's below that and someone executes that option against you. Or you could use something in between and say, well, I'm happy buying it down about 8% and do that, and that would boost your yield. So the closer you get to being in the money, the higher premium you're going to get for writing that option, the higher yield you're going to get, but you're taking a little bit more risk. You have to be okay with the idea of buying it at that price. And generally speaking, if you study market history, the average correction is 13.4%. And you're a statistical fool if you're not on average a buyer once you're down 13.4% from the top. Now, as you can see, in 2000, 2001, 2002, we had much bigger drawdowns in 2008 and 2009. But on average, if you looked at all the pullbacks over history, If you're a buyer down 13.4%, you do well 1 year forward all the time without exception. And that's something that a strategy like this, when you're nervous about the markets, educate yourself about how to use the various different strategies like this. Again, it's only available in a margin account because you theoretically, being short the market with a naked put, have an unlimited liability, and therefore you can't add to your RSP account if you're already capped, and therefore can't do it in a registered account. And finally, looking at some of these inverse ETFs and the volatility ETFs specifically, the red line there is the total return of the SPY ETF, the typical long, and the blue line is the single inverse ETF, which, as you can see, is about 1-to-1 compared to the other one. The double decline is the pink line, but the volatility ETF, and I get many questions on BermansCall about this, is exceptionally volatile. And I mean, it's not for long periods of time, because if you bought it a couple years ago and are still holding it waiting for that correction, and you didn't get out of one of the corrections in 2015, early 2016, in the middle after Brexit, or the little one just before the US election, you would be down over 90% in that position. And that's why I say the more volatile the leverage ETFs are, the more they go up and down every day. And the most volatile thing is volatility. And the second most volatile thing is natural gas. Maybe red peppers are in there, but we can't trade the price of red peppers or grapes at the supermarket. But those of you who do the shopping in the household like me know that the volatility of red peppers and green grapes are pretty volatile week to week. So I'm going to show you a little bit about how I do things in the Sleep at Night portfolio, how I look at the market, how I set up some of my technical indicators, and then we'll have, I think, a good 20 minutes or so for questions. So one of the, there's a firm in the U.S. called Dalbar, and what they do is they actually do a study where they look at all the buy and sell transactions in mutual funds. And in recent years, they've added ETFs into these because, in effect, an ETF is like a mutual fund. And so if you look at the top column there on 30 years, and you look over to the header S&P 500, the buy and hold return over the last 30 years, if you had just bought that SPY ETF when it started, was 10.35%. If you just held it and made no trades. And the smartest thing to do ultimately is to do that, is not to trade, not to generate commissions, not to pay anyone else, just to buy and hold a good asset mix and defer your taxes and everything like that. That's the smartest thing to do. However, the human condition won't allow us to do that. Dalbar calculated that for equity funds that track the US S&P 500, with all the buys and sells that they figured out, that the average person holding those funds experienced a return of 3.66%. And it's because of that emotional, when we see the market go down, we get stressed and uncomfortable and we stop out. And we do that over and over again. And how it kind of manifests itself is the example on the right here. So HEDG was the first ETF that you could buy that hedged the currency risk in Europe. And it's a Europe ETF from Wisdom Tree, so it's a smarter ETF strategy. And it hedged the currency. Because if you bought into the idea that Europe was going to be recovering after, in 2012, Mario Draghi said, we're going to do everything we can, buy bonds, cut interest rates. The euro at that point was about 140 to the US dollar and ultimately bottomed out last year at around 105, currently sitting at around 114. If you didn't buy Europe with a currency hedge, you lost about 25% just on the currency. So as Dan mentioned before, when you invest globally, currencies can really help you or really hurt you. So this was the first way you could buy Europe hedged. And I had talked about this on the show a few years ago. So in 2013, what people did, or the end of 2013, people looked in the rearview mirror and said, wow, look how great Europe's doing. It's really awesome. The performance is great. And then they started buying this ETF. And the green bars there above the line, those are net flows going into the ETF. Okay, so they're net units measured in thousands, I think, going into the ETF. And so in 2015, you had every strategist in the world on Wall Street saying, buy Europe, buy Europe, buy Europe, way better than the US, buy Europe. And a huge amount of money went in, and it shot up. And then in the middle of 2015, they went and looked at the economic data of the last couple of years. They saw what Draghi was trying to do with the LTRO platform and all these other things that they were trying to do quantitative easing with, and realized that it wasn't working. And then he said, we're going to go to negative interest rates. And then people said, uh-oh, that's really bad for the banks. And so they started to sell off the European securities. But it wasn't until the market was down about 10 or 15% that the red bars started showing up in a big way, and people were redeeming. So everyone who bought at 60, 65, 70 are now, for the lack of a better word, puking it up when it broke below 60, and they're just getting out because they can't stand it anymore. And now, in the last month or two, that we've broken to new highs in Europe, green bars are starting to come in again, and this is probably the time to sell Europe again. Yet, people do it the wrong way. Why do they do it the wrong way, Dan? They do it the wrong way because they're chasing past returns. They're not thinking about what the likely return is on a go-forward basis. And that is so important. So even the smartest investors, like my friend Warren here, don't beat the market all the time. This graphic is a relative performance, the blue line is relative performance of Berkshire Hathaway's public record. So before 1981, back into the 1960s, it was a private corporation. Berkshire became public 1981. When the blue line is above zero, Berkshire is outperforming the return of the U.S. equity market. And I've said many times on BNN, since 1998, so since that high point in 1998 to today, Berkshire Hathaway on average has spent more time below the return of the U.S. market than above. And when the tech boom hit from 1998 into 2000, and the S&P 500 went up 60%, and the NASDAQ doubled and then doubled again, Warren Buffett underperformed by 63%. So not only did he not catch the upside, Berkshire Hathaway actually fell during that period. Why? Because the money came out of McDonald's and Coke and Procter & Gamble, and it went into the dot whatever of the day that ultimately blew up. And he outperformed the markets when they collapsed in 2000 and 2001, and he went up when the markets went down, because all the money came back to Coke, Procter & Gamble, and the real companies, and the dot-com of the day blew up, and many of those companies, as you know, today don't exist. Of course, there's a handful of them that are now leading the current technology charge, and we'll see how that goes. But even the smartest investors don't know how to beat the market all the time, and this is a great example of that, and that's why I think using smart indexes and getting the benefits of diversification are more important than anything else. So just to reiterate the idea, I want to calculate a forward-looking return, and here's how I do it. So one of the reasons we do this, and what we recognize as our point of maximum risk, is something Warren Buffett says, and market fluctuations should be our friend, but most people fear them. And the point of maximum risk in our portfolio of 10% is that long-run average. We must be a seller, on average, when the past return has been higher than the long-run average. And we must be a buyer when we've had a period of returns when they're way below average. In other words, buy low, sell high. And it sounds contrite and it can't sound simple, but it's really not that simple. And the reason we do this is what we know from behavioral finance. Daniel Kahneman and Amos Tversky won a Nobel Prize in 2002 for their work in loss aversion theory, or what's known as prospect theory. And markets work this way because of how people process gains and losses in their portfolio. So on the right side of the grid on the x-axis, we have gain in the portfolio, and on the vertical axis, we have happiness, positive psychology, or unhappiness, negative psychology, versus on the left side of the axis, we have losses in the portfolio. And initially, as we're making money, we have a good degree of happiness. As we increasingly make money, we get euphoric, and then we get complacent. In other words, at some point, you can only get so happy, okay? But faced with the same dollar amount of losses, initially, people are about twice unhappy with that value of the loss than they are with the same value of the gain. But the more they lose, the more unhappy they get. There's no complacency at a bottom. You get capitulation and depression. So this theory explains why we need to sell high and buy low. Because Warren Buffett also says, buy when there's blood in the streets. As a value investor, you're looking to buy when things are cheap. And I always say, people call into BermansCall and ask about momentum stocks breaking out to new highs. I throw up my hands. I'm not good at that. I don't know when it's going to stop. It could go for a long time. You could trail stops and day trade it if you like. It's not what I do. I'm much, much more strategic than that. I look for value. I look for things that are undervalued, that have good long-term potential, and that's when I want to be in them. And so here's where it comes into the charts. So in my trend evaluation, I run a statistical technique called a linear regression. And I run that line back for a year, and I say, where are we today relative to other points in history? So as you can see today, the slope of that one-year trend line, call it 240 for rounding purposes, compared to a year ago at 210. So we've had a period of a year where the return's been above 10%. So I say, well, what happens historically when my one-year return is above the average and we're currently at the mean of that trend? And I can go back for 90 years on the S&P 500 and calculate what that expected return and risk is. So I do that. Well, how about at a point in March? So we got to a period in March where that slope of that trend line compared to the year before was 20%, and we were at 2 standard deviations above the trend. Historically speaking, when you got to that point, you're a statistical idiot to still be in the market with full risk on, because the expected return for the next 3 months on average is 0. And you can see that if we draw the line across from March, April, May into June, basically there's been no return for the 3 months from that point on, and you had a lot of downside risk in between. Now, this doesn't guarantee that, but it does give you some idea on when it makes sense to take money off the table. How about looking at the early November, late October sell-off? Well, at that point, if we drew the line back a year, the average line was flat. So we had 0 return over that year, and we were 2 standard deviations below. What is my forward-looking return when that happens? And it turns out it's fantastic. And so that was a great buying opportunity. Now I look at a momentum indicator at the bottom, and what I use there is the difference between a 1-month moving average and a 3-month moving average. And the dashed red line across is 2.5%. And the reason I look at 2.5% is because if 10% is my long-run average number, which it is for large-cap U.S. equities, then my quarterly expectation is 2.5%. So when my 1-month average is 2.5% or more above my 3-month average, which is the black line, and then I lose momentum, so my moving averages start to converge by a week. That red line is a 1-week average of the black line. If I go back historically and measure, that's another good time to take money off the table. So I have a way of looking at what my forward-looking return and risk is going to be at any point in time, and I factor that into my model and my portfolios, and that's how we figure out how to overweight and underweight different sectors in different parts of the world. Now, when we're looking at measuring capitulation in that market bottom, you know, that oh my God event, get me out, I can't sleep at night, the RSI indicator is very good for that, also the VIX index. So if we measure the RSI indicator back historically, the average reading is 53, and our 2 standard deviation statistically significant point is at 31. Historically, what is my forward expected return when I have an RSI reading of 31 or lower? And it turns out it's excellent, looking out. And I've run this back till 1926, so I've got a very, very robust set of data here. And if at the same time we're down 13.4% like we were in January and February of 2016, then it becomes a 95% chance that within the next 3 to 12 months, you're going to have a significantly higher average return than any other point in time. RSI indicator isn't very good, for example, at market tops. It's much better at market bottoms. So I overweight it when we're looking for bottoms, and I underweight it when we're looking for top patterns and so forth. So that's how I start to use my technical indicators and incorporating them in. I don't look at chart patterns. I don't think they matter that much. The efficacy of most chart patterns aren't great, and that's how we do our asset allocation. At the end of the day, the Sleep at Night portfolio, as of last weekend, has about 8% cash there, as you could see. The total security selection. I have a little bit of gold. I noticed a question on gold came in, so I've got GLD, so I got a little bit of gold, and I got some TSX gold stocks. I could take the gold weight up to about 5%. Again, keeping in mind I want to be diversified, so I got a little less than half a position on in gold. If gold pulls back some more, the risk return looks favorable. And overall, you could see that compared to the world index, the VT ETF, we generate a higher average return with significantly less risk. We're not going to beat every single ETF out there because that's not what we're trying to do. We're trying to get a good, diversified, low volatility, good sleep at night ride. Some of the ETFs we currently hold now, there you can see the ZPW and ZWH making up a big portion of my US. To play defense right now, I've got a bunch of short-term corporate bonds. It doesn't bother me that they've come off a little bit at all. This is something that's yielding me about a little over 2%, and I'm just waiting to deploy that money into equities at better levels. I've got some of the covered call utilities and the high dividend covered call strategy. So when I'm playing defense, I have a lot more of the covered call, high dividend focus, lower volatility type of stuff in the portfolio. Dan mentioned preferreds. I've got a little bit of that. But I just started adding some direct exposure into energy a couple of weeks ago. So I've got it on an equal weight basis with ZEO in the BMO world, and I've got a 1% position in U.S. energy stocks that we bought last week when oil was at 42 and everyone hated it. That's when the risk reward was most attractive, and we were adding it to the portfolios. As you can see, I bought some banks, ZWB currently because I want to be a bit more defensive. Bought those a few weeks ago when everyone was worried about the banks and they were selling off more aggressively. I think that position's up 3 or 4% already from where we bought it. I've got some of the defensive consumer staples. The AMLP is the pipeline trust in the U.S. that yields north of 7%. I bought that about a week ago when they were selling like crazy all the energy stocks. We bought that at 11, maybe 11.10, 11.15, I think, and today it's at 11.80, and it yields me north of 7%. So that's a good holding, and so we have a bit of an overweight now in the energy sector. But that's essentially it, folks, for the part of my presentation to show you about how to use these smart strategies, incorporating them into your portfolio, looking for opportunities of risk and return. And so a couple questions that have come up here. Let me get into them. What are your research tools available to your audience online? So the answer, unfortunately, is no. I use Bloomberg terminal to drive most of the data into the models and the spreadsheets and the computer programs that we've built. I would conservatively say building all of that technology and software has cost me close to $500,000 over the last decade. So it's not something I'm going to give away for free, and I have no plans on selling it at the moment either. You can access it through buying the funds, etc. I do like to show people how we do what we do, but there's nothing on the internet for free that's going to give you this level of insight and access. You got to do some work. Like Jim Cramer says, got to do your homework. And the homework for me, build some spreadsheets, put your data in there, crunch the numbers. You can do everything that I do here on spreadsheets. That's where I started. As now we've moved into the cloud and we're building software around that. But in the very early days, years and years ago, everything we did was on spreadsheets, and it's still the capability of Excel and Access databases, are still very much there. Question: minimum and maximum position sizes that we suggest. Again, in our world, the portfolio optimization technique in the Markowitz-Sharpe model. So if you go out and Google Markowitz-Sharpe, Nobel Prize 1990, you'll come across this thing called the capital asset pricing model. You can download, if you do a Google search, spreadsheets that people have put up there that will allow you to build ETF portfolios using this technique. All you have to do is be able to estimate what the expected return and risk is for the various different ETFs that you would use in your portfolio. So there's some freeware out there by way of spreadsheets. Looking back, 10 years ago, I was talking to a professor at a university in the U.S. who had a YouTube video. It wasn't a YouTube video. It was something on the internet back then. I don't think YouTube existed. And he sent me his spreadsheet. I asked him for it. He sent it to me. I built on that. So there's a lot of stuff out there that could be helpful. The risk and return parameters define how much overweight and underweight you can be, but you can also control for that, saying, I want the lowest or maximum diversification, meaning I want my beta to be at 70% or lower, meaning the risk factor 70% or lower, and it'll tell you, based on the standard deviations of all the different ETFs that you're going to use, where the weight should be. You can also physically constrain. So if you're running a global portfolio today, the U.S. is about 53% of the world markets. So if you want to beat the world index VT ETF that's about 53% U.S., and your models are telling you that the U.S. is the place to be, you're going to have about 60 or 65% in the U.S. in order to make a meaningful difference in beating that, just buy and hold the index. So that's the kind of thing when you talk about position sizes. Why do the term short and ultra short-term bond ETFs go down when interest rates go up? Why don't they just hold the bonds until they redeem? Well, because short-term bonds, like a 2-year bond, has 2 years to mature, and they do hold them typically to maturity, but there is still price volatility in the underlying security that would get passed through to the net asset value on a day-to-day basis. So there is still that volatility, even though they're short-term. Unlike a money market instrument that's issued at a discount, so you get 100 back at the end. You may have bought it at 99 the year before, and that 1% you get. So buying at a discount, you're always accruing that interest in the note itself, as opposed to buying the bond that pays out a coupon and therefore has a variable price. Hopefully that explains that to you. What's the cost of investing in your tactical ETFs, and how can we invest in them? Best thing to do is follow up with us with an email, and we'll have some information on that. But make sure, if you're using a discount broker, BMO Investor Line or something like that, that you ask for the D class funds, the discount class funds. They're similar in cost to a robo-advisor, except you're getting active management. All-in cost is about 1.1, give or take, yeah, about 1.1%. So all the advisor compensation is stripped out of it. Included in that 1.1% is the fee that I make for managing it, the cost of the underlying ETFs, and there's a small fee that goes to the discount broker compared to a full-service advisor that would have that fee up around 1.85%, just for comparison purposes. And we'll be sending out to our distribution list when our robo-advisor is ready. We'll be using the similar approaches and whatnot in those ETF portfolios, and those all in will be about 1%, something like that. Okay, the sleep at night, is that the tactical dividend fund? Well, all our portfolios follow the same thing. The sleep at night portfolio, the global tactical dividend portfolio, has been out the longest. It'll be about 4 years in August. Currently rated by Morningstar, if you look at the different classes, and 4 or 5 stars. So what a 4-star fund means, it's a top quartile performer. What a 5-star fund means, it's in the top 10% of the equivalent universe. So it's been doing very well in that regard, as you can see. The growth fund and the balance fund, you don't get a Morningstar rating until they're 3 years. The balance fund's been out a little more than 2 years, and the growth fund's been out a little more than a year. But if they were in their peer groups being measured, the balance fund would be a 3-star fund at this point, in the middle of the top half of the quadrant, and the growth fund is in the 4th quadrant as well in terms of performance, may even be in the 5th, but it's around 85 or 90 percentile as well. What else do you have here? Let me look. Okay. What are you averaging per year with this portfolio, 2014, 15, and 16? So what this shows you is a gross average return of about 9.5% per year, per annum. And when you compare that to the world index, or to the Claymore, the iShare, the CYH, which is a global dividend currency hedged strategy, which is the most similar plain ETF to what we're trying to do. I think the MER there is about 66 basis points. That is a little around maybe 8.5. So we're about 1% better than that. We're about 2% better than the world index, 1.8% better than the world index. And we do that with about 30 to 40% less risk, less standard deviation. And that's the other big thing. And that allows you to ride it out a little bit more. Well, yes, the webinar will be is being recorded and will be shared with everybody within, I think, 24 hours. We'll push out an email, so if you want to watch it again or actually get the PDF of either Dan's presentation or this one, will be included as well. Briefly explain the difference in pros and cons between the 3 Larry Berman ETF mutual funds. So they're all global in scope. One is a balanced strategy, which is your traditional 60-40 balance, but the difference being we can really turn up the equity exposure to as much as 80% when we really like equities, and turn it down to as low as 20% when we really don't like equities. So in most market environments, we're going to be very, very active in moving the range around and trying to deliver a total return in most markets. We can't go short, we can't use the inverse ETFs, but through asset allocation between stocks and bonds, we can really try to generate good returns in something like that. It's our most defensive strategy. Currently, the internal yield Depending on what unit you buy, the gross yield's about 4%, and the distribution yield would be, if you're buying the D class, a little over 1% less than that. And in the growth fund, it's more equities more of the time. We're trying to grow the portfolio, 70 to 100% equity exposure, so it's more volatile, a little more risk to it than the dividend fund, which can get really, really defensive. But even in the growth fund, which since inception in April of last year is up about 20%, something like that, and is about 5 or 6% ahead of the world index, and is 10% ahead of the world low volatility index. Same idea, but it's more equities more of the time and just a little more standard deviation than you would have in the dividend-based strategy, and it would be a lot more standard deviation in the balanced strategy. So when you're really bullish, you want the growth fund. If you want the monthly dividend payout, you want the dividend fund. And if you want a safe ride within a balanced, traditional balanced portfolio, the balanced portfolio would be the one that you want to go for. And I've got about 5 more minutes here, and let me see if there's any more questions. There was a question early up front that came in on HFR, and so that wasn't a BMO ETF, and I didn't give that one to Dan, but I believe that's the Horizon Actively Managed REIT ETF. I think that's what it is. And the comment here was it's a relatively safe income investment, REITs yield about 5%, to replace interest and money market funds. And I can't say no with an exclamation point enough. You cannot replace fixed income and money market with equity type strategies. REITs have less volatility on average than equities, but in a rising interest rate environment or regressing rising interest rate environment, REITs will get absolutely obliterated. So you don't have bond-like risk. You certainly don't have money market risk. You have an attractive yield, no doubt. My current exposure in REITs, as you can see in this portfolio, and I would typically own ZRE, is 0, because the risk-adjusted returns going forward are not attractive. I have just been told by Dan that it's a floating rate bond ETF. Sorry, different question. So that would apply for the REIT ETF, but I do get a lot of questions, Dan, on the covered call strategies because they're higher yielding. Can they be bond-like replacements for like ZWU, for example, the utility one? And the answer is no. You're going to have less volatility because utilities overall typically are less volatile, but in a rising rate environment would be more volatile than bonds. But the floating rate bond ETF is really something that owns floating rate notes where the interest rates constantly adjust, so you don't have as much price risk in them. And so that is something that you could use to replace money markets and shorter term bonds, but they're not riskless investments. You can still lose money in those, especially if you get a lot of short-term, more aggressive rate hikes, that those can also perform with some capital risk. So keep that in mind. But yes, that would be more bond-like question that David asked there. Okay, I think I've got to most of the questions. Let me just look here. What are your average MER fees on these ETFs? So they're not my MER fees. What's the BMO Universe average, Dan?
Probably like 30, 25.
Yeah, 25 to 30 basis points. If you're talking about the simple index like the TSX replication, 5 basis points to get the entire TSX index. So, you know, by all means, if you're not using ETFs and you're using high-cost active management funds, you got to question the portfolio manager and their ability to generate excess returns above the extra 2% or so that you're paying for that fund. And if they're not doing that on a consistent basis, then you should really consider using the very low-cost ETFs. Then the question goes to, do you want to be in the Canadian market more, the U.S. market, international markets, or some of these smarter strategies to help diversify your portfolio? Can I still invest in ETFs in an RDSP? And the answer is yes. Any registered, in this case a registered disability savings plan, ETFs in their legal structure are mutual funds in that regard, but they have all the costs other than the basic management fee of and slight profit for the dealer. As you can imagine, putting together an ETF like ZCN that replicates the TSX index identically for 5 basis points. So you've got cost involved in doing all those things, and someone's got to be paid to do it, and so the profitability is pretty much next to nothing in that regard. And the comment is, wow, cheap. Yeah, very, very cheap on average for ETFs. They're great in this regard. And so I think that's it in terms of the questions that have come in. If I missed one of your questions, I apologize for that. But this presentation will be saved, it will be archived and replayable probably for a number of months, and we'll send out a thank you to everyone who attended, and we'll send out copies of the PDFs for those of you who want to have a look. So thanks very much, and keep watching Berman's Call.